We mentioned municipal bonds and the taxation there. One of the things we want to be able to do is make comparisons between taxable debt income and non-taxable debt income. Non-taxable income comes from two forms. It can come from investing in treasury bonds, but it can also come from investing in municipal bonds. Essentially, the way the rule works is you pay tax to the entity that created the bond. So if you buy a United States Treasury bond, you would have to pay federal taxes, but not municipal taxes. If you buy a municipal bond from any state in the Union, agency debt, state and local government types of debt, if you buy any municipal bond, you don't pay federal taxes, but you do pay local taxes. The only exemption for that is if you buy the debt, the municipal debt, from an entity from within your state. In that case, we refer to them as being triple tax exempt debt. So there's a calculation, right? The municipal bond is paying 8% and the corporate bond pays 10%. If you're at a federal tax rate of 28%, the question is, do you want to receive the muni and have 8%, or do you want to receive the corporate bond and pay 10%? Well, after you pay the taxes on the corporate bond, you're going to be left with 7.2%. So which would you rather have after taxes? 7.2% or 8%? And of course, you'd rather have the 8%. We had talked about standard deductions. What are the amounts? Well, if you're single, the government says, we're going to give you $5,950 as a deduction from your taxes. And then from that amount, you calculate your tax. If you're married filing jointly, you get $11,900. So when this becomes important is to say, well, I have some deductions that I may want to utilize to reduce my taxes. So what kinds of deductions are those? And they're all listed here. It's in the itemized form for calculating taxes, but there's medical expenses, state and local taxes. That would also include like real estate taxes. If you have equity interest expense, that's deductible. Charitable contributions, theft and loss, you can read them there. But these deductions, if these deductions, and again, some of them have special rules, but if the total of those itemized deductions exceeds the balance here, for instance, if you're married filing jointly, let's say you have a house, and from that house, let's just use the house interest alone, let's say you paid $12,000 in interest expense for the year. Well, if we go back this, you get $11,900, but you've got $12,000 here. So since your itemized deductions exceed your standard deductions, the one the government gives you automatically, you would then use the sum of all of these to reduce your taxes to ultimately calculate taxable income. The exemptions that we talk about have to do with dependents. You're obviously your own dependent. A spouse would be a dependent. Children could be dependents. But also we have for age, if you're over a certain age, and or if you have a disability, you can also take further exemptions, again, ultimately to reduce taxes to get to a lower tax rate. So once we get to this taxable income, we then calculate the tax themselves. There is a basic computation. We'll talk about that here in a second. But we've talked in a lot of classes about something called the marginal tax rate. And it's important to understand that rate to understand how further income impacts your taxes that you pay. So let's think about this. If you are investing in an IRA, and the IRA has some profitability. How does that affect your taxes today? And the answer to that is it doesn't affect your taxes today because that tax is deferred until retirement. What about long-term capital gains? How does that affect taxes? Well, the maximum tax you pay on long-term capital gains and or dividend income is 15%. So those ultimately have a tax rate that's less than what your marginal tax rate would be on the rest of your income. So in the end, we would say, well, why is this important? Well, what happens if you have short-term gains? If you have short-term gains, they're going to be taxed at whatever your marginal tax rate is at the end of the year. So if that's in a very high tax bracket, maybe you want to hold off selling that asset and taking those gains until you get to long-term capital gains. But regardless, once we calculate the tax, there are a variety of things that are referred to as tax credits. Each one of these has separate rules. There are education credits. There are student loan interest credits. So these are all credits that you can take that ultimately reduce the tax you pay dollar for dollar, and of course they do have limits to the amount. Now, one of the things that's a little strange and different with respect to personal taxes rather than corporate taxes is the concept of an alternative minimum tax. There is a minimum tax that you ultimately must pay, and if that tax is more than what your calculation is up here when you calculate after the tax credits, then you have to pay the alternative minimum tax instead of the tax that is due from your calculation. And the reason this alternative minimum tax comes about is because of some of these credits that you take, some of the income that you account for, because it has certain tax benefits to it. So again, we're not going to calculate alternative minimum tax, but you just need to know that there is the potential that there could be an additional tax that you may have to pay based on the kinds of income that you have. We've done this kind of calculation in previous courses. This is essentially how you calculate the taxes on income. There's a tax bracket, and of course here is the formula for you to calculate the income. So if you're married filing jointly, you can see that the marginal tax bracket, the maximum tax bracket you pay, is 35%. And also, if you remember, the marginal tax rate at the highest level of income for a corporation is also 35%. So you can calculate the taxes fairly simply. Taxable income is $200,000. You find the status of the person. Once we know that, you find the lower number, find the difference between the two, enter the tax rate, 33%. So you're going to pay $7,085 plus the $43,482. So the total tax burden for this person is $50,567. And we've done this calculation in other classes, so that shouldn't be earth-shattering as to how that calculation is made. We do, again, talk about these tax preference items, or the items that ultimately impact whether or not you pay the alternative minimum tax or not. So your tax liability is the greater of this alternative minimum tax or the tax that you actually calculated. Again, the things that impact this are the tax preference items and some of the selected deductions and adjustments that you take with respect to income. There are some education provisions just to kind of identify some of those things that is going to impact most of us, since we have children and we're obviously still going to school ourselves. There are some IRA type things. You can write off $2,000 from the Coverdale savings accounts That reduces to adjusted gross income. Likewise, you can write off some parts of the qualified tuition programs from state taxes. If you're an employer-provided education assistance program, they can give you up to $5,250 without taxation if they choose. That can also be used for graduate programs. Student loan interest, you can actually take a deduction of up to $2,500 of this interest. Again, you can do that whether you itemize or not, so you don't need to have that as an itemized kind of an item. It's a credit that goes along with income. And of course, we also have higher education expenses. You can write off things from what are referred to as HOPE and or the lifetime learning credits. HOPE credits are typically for freshmen and sophomores. Lifetime learning credits is credit you can take any time after those first 2 years of education. Don't really want to talk a lot about corporate taxation, but of course you know that there are taxes that have to be paid. Individually, companies are taxed, or individuals are taxed to their personal income tax for income that comes from the S corporations, sole proprietorships. Basically, that's our 1099 kinds of income. So we want to talk a lot about corporate taxation. This is a personal finance course. So that's the end of this basic description of taxation.